How's it going, everybody? It's Stas here. So I wanted to make a case on why the stock market could be considered overvalued, right? Here across YouTube, across the financial media, pretty much everywhere, right? A lot of people talk about how the market is bullish, we're going to keep going up, and we never hear the bearish points, why the market could be overvalued, and quite frankly, why the market could be due for an overall correction. So sit back, relax, take a sip of your coffee, and let's get right into the video. So we're going to talk about the Schiller P here in a little bit. We're also going to discuss the federal funds rate later in the video as well. But first, let's just take a look at SPY here, the S&P 500. As a matter of fact, let's just go straight to SPX and just pull up the S&P 500 index so we can see how it has done over the past 20 years, right? You guys can see in 2001, 1295, we went down to about 830, hit a low of 666 in 2009, and ever since that point up until now, we ran up a ton, right? It went from 666 up to 4238. That is the current all-time high. And throughout this time period, pretty much a 12, 13-year straight-up rally with just mini crashes in between, really just two main mini crashes in between. We've gone up like crazy. I mean, it's pretty obvious, right? If we pull up here on the 3-year chart, you guys can see when the Fed, and this is kind of talking about the funds rate, when the Fed tried to increase rates 2 years ago, right? Or really almost 3 years ago at this point, S&P 500 went from a little bit under 3,000 to 2,300 very quickly. Do you guys remember that? It literally bottomed, I believe, on Christmas Eve, and then from there, they're like, no, we can't do this. We got to go back down, and then the stock market ended up going up. So you guys kind of see the correlation there, right? When the Fed has interest rates close to zero, the market does well, but when there's worry about them increasing the rates, or if they actually do increase the rates, the market ends up collapsing, right? And this is what we noticed with what happened here, right? We can see in March 2020, SPX went from 3,400 pretty much all the way down to 2,100, and the Fed rate wasn't zero at that point, right? But to dig us out of this CV craziness, and CV, you know what that is, right? And the whole economic shock, to dig us out of that, they printed, and by they I mean the Fed, they printed a lot of money, and they put that interest rate down to zero, right? It eventually got down to zero, where it still is. And from there, you guys can see the crazy V-shaped recovery that we've seen. And with this V-shaped recovery, yes, a lot of us, pretty much all of us out there, we made money in the stock market. I know you know somebody that made money in the stock market, right? I know you started hearing the random person at the gym talking about stocks, or you go to the convenience store and the clerk's talking to you about stocks. Everybody and their grandma is talking about stocks right now, and they're making money in the stock market. And it's crazy whenever you hear random stock picks from just random people out there on the street. They're like, oh, have you heard of this? Yeah, this is going to 10x in a month or 2 months. These are all signs of euphoria, right? So let's go to that Schiller P right now that we've seen what the chart has done, and we'll talk a little bit about that and go over what it represents. Okay, guys, so this is the chart that I really want to focus on, and this is the Schiller P. Currently, the Schiller P is 37, and according to the past 20 years, the Schiller P is currently at a high when it comes to this 20-year chart at, again, like I said, 37. And what is the Schiller P? Well, this is also known as the CAPE ratio, right? Think of Superman. He's got a cape on, the CAPE ratio, right? And the CAPE ratio is a valuation measure that uses real earnings per share over a 10-year period to smooth out fluctuations in corporate profits that occur over different periods of a business cycle, right? So this is very important, because if you're looking at the PE ratio of a company, not the Schiller P, the PE ratio. In general, PE is just the way that you can value a company, right? Let's say the S&P 500 has a price to earnings ratio of 25, and in layman's terms, let's say company A has a PE ratio of 35. It is more expensive than the overall index. And if it has a PE ratio of under 25, in layman's terms, it is less expensive than the S&P 500. There's a lot more that goes into it, but in brief terms, that is one way you can value a company. You take the price of the stock divided by the earnings per share, and that's the PE ratio. And the beautiful thing about the Schiller P is, like I said, it's a 10-year smoothed out line. So it's not like PE 1 year is 24, then it's a 17, then it's a 40 the next year. It's smoothed out, and it's pretty much an average of the past 10 years. It accounts for inflation and a bunch of other metrics, but overall, that in brief terms is what the Schiller P is, and this is a more reasonable market valuation indicator than the PE ratio itself, like I said, because it eliminates the fluctuation of the ratio. And if we take a look at the all-time historical average here, it's 17, so we're well above the historical average of 17. Again, we're sitting at about 37, and we're not at an all-time high. It's pretty interesting to see when we were at an all-time high. That was in 1999, the dot-com bubble. The Schiller PE was at 41.90. It actually got higher, 43 on March 1st of 2000, and, well, not 2001, just 2000. And from there, it dumped all the way down to a 14 Schiller P before it's now at 37. So overall, in terms of Schiller P, this is an overvalued market. We are approaching to levels of the dot-com bubble. But there's a big distinction, in my opinion at least, and a lot of people say this, right? I'm not just pulling this out of my you-know-what. There's a big distinction between now and the dot-com bubble. The tech stocks now, for the most part, are a lot more stable. They make money. They make profits. Back then, that wasn't the case, right? So that's the big difference, but that doesn't mean that we're not overvalued because, again, we are pretty overvalued. But that being said, the closer we get, let's say we have a market correction and we drop 20-30% on the S&P, which could happen very easily, like history has shown, we could get maybe down to a more attractive Schiller P, maybe down to a 17, 15, maybe 20. These would be more attractive levels, but here at 37, not so attractive, right? And if you look up here, this is how the Schiller P is calculated. You use the annual earnings of the S&P 500 companies over the past 10 years. Like I said, you adjust for inflation using the CPI number. Past earnings are adjusted to today's dollars. Average the adjusted values for E10, and the Schiller P equals the ratio of the price of the S&P 500 index over E10. So that is the basic formula there. And again, we're at pretty much all-time highs for this Schiller P. And these are interesting metrics here. The recent 20-year low is 13, and the recent 20-year high is 37, where we are right now. And we're 44% higher than the 20-year average of 25. That scares me, guys. The fact that we're 44% higher. Look at what I'm highlighting right here if it wants to work. There we go. The 20-year average is 25 Schiller P. We're at 37. That's 45% higher. So let's talk a little bit more about the Fed funds rate before I end off this video. Okay, guys, look, this is the effective federal funds rate, and we all know the crazy amount of inflation we had in 1980, right? And that's something I didn't mention before. When there's high inflation, that is when the Fed increases interest rates to fight that inflation. And that is a real fear right now because a lot of people are saying we're having inflation like the 70s and 80s again, which I'm not necessarily saying that myself. That's what some experts are saying. Then we have other experts saying, no, this inflation is nothing like back then. It's transitory. It's going to be fine in about a year or two. So there's two different sides of the coin, like always, guys. But me looking at at this from a contrarian perspective, I'm a little bit nervous. I'm being a little bit cautious because what if inflation is much worse than they think and they have to jack those interest rates up to 4% to fight it, 3% to fight it? Remember, we're at 0 right now. As you guys can see on this chart, we're literally at 0 right now in 2020. If they end up jacking those rates up, we're going to see a serious market correction, guys. I mean, this is what I was talking about earlier in the video. Look at what they did in 2017, well, end of 16, heading into 17, into 18. They slowly creep those rates up, and then boom, we collapsed. You guys remember the markets bottomed literally here? It's crazy. They bottomed here December in 2019, or 18 rather, and then we crossed over into 2019. And then the interest rates dropped. The market continued to go up from there. And then February 2020 hit. Interest rates, the Fed funds rate was at 1.58. And then you know what happened from there. The markets collapsed. They cut that to 0. And then here we are, present time. So I hope this video gave you all a little bit more insight on the Schiller P, what's going on right now with inflation, the federal funds rate, and just to be cautious out there, guys. Don't always think everything's sunshine and rainbows. You have to be prepared for the worst and really look at the market from a contrarian point of view, because what if the markets collapse, interest rates go up, inflation's worse than we thought? We're going to be in for a rude awakening. Well, me, not really. I'm prepared for this. I'm aware of this. But people that aren't aware of this, well, they're going to be in for a rude awakening. And how could you prepare? Well, have some cash, right? Buy some gold, buy some silver. You might call me a boomer, but I think gold and silver, they're great as an inflation hedge, as a store of value. Buy some Bitcoin, buy some Ethereum. And I'm not telling you to buy. You must always do your own research. But this is kind of what I've been buying to do, to hedge against inflation and to kind of prepare for the worst. And like I always say, cash is an asset class, right? Cash is an asset class, and it helps you during those rocky times, during the times the markets go down, because you can pick up shares at a cheaper price. And another thing worth mentioning, I almost forgot before I end off this video, when the interest rates go up, right? This makes cheap money not so cheap anymore. So a lot of these high risk, high multiple, high growth stocks, their valuations have to come down to account for that increased discount rate. That is very important. You guys have to remember that, right? And that is exactly why we've seen a collapse in a lot of the Cathie Wood stocks, a lot of these higher multiple stocks, high growth stocks that don't necessarily have much earnings right now. They're borrowing a lot of money, and the discount rates, it's serious. That's a huge part of valuating a company, looking 5-10 years out. So I hope you all enjoyed the video. If you did, smash that like button. Make sure to go down below. Check out the Patreon if you all want real-time buy and sell alerts, more access to me throughout the day, trades I'm making, options moves I'm looking at. And if you want a morning update video every day, that is on Patreon, link down below. Or you guys can go to patreon.com/DasSurFest. That's patreon.com/DasSurFest. You could also get 2 free stocks from WeBull, link down below. All you have to do is deposit $100 and you get 2 free stocks valued up to $1,600. And do you have an M1 Finance account? Because you could also get $30 with them. All of those are linked down below. Thanks again for tuning in, guys. I'll see you all later on. Stay safe out there. Keep crushing the markets and be prepared for the worst. Peace out.